Please like, share, and subscribe. Wishing you happiness and good luck every day.
You know, you hear about hedge funds all the time. You see them in shows like Billions, you hear these wild stories about massive fortunes won and lost, but they always feel like this big secret. They're a massive part of the financial world, but what are they, really? Well, that's what we're going to do today. We're going to pull back the curtain using Anthony Scaramucci's The Little Book of Hedge Funds as our guide to figure out what these things are, how they work, and, why they matter so much. I mean, this quote from the book just nails it. Wall Street's last bastion of secrecy, mystery, exclusivity, and privilege. Those words aren't just for dramatic effect. They pretty much define the entire industry. This is a world that is intentionally hard to get a peek into. It's a private club, and the stakes are incredibly high. So, okay, what's actually behind that veil? What are these things, and what do they really do? That's the mission. That's what we're here to find out. So let's start with a proper definition. To get our heads around it, the book suggests a pretty cool approach. Think all the way back to high school biology class, right? We're basically going to dissect this thing piece by piece to see what makes this so-called capitalist pig really tick. All right, so here's our working definition. A private investment pool for wealthy people using flexible strategies. But the real magic, the key phrase is right at the end, seeking absolute returns. Unlike your typical mutual fund, which is just trying to beat the S&P 500, a hedge fund's goal is just to make money. Period. It doesn't matter if the market is soaring or crashing. Their job is to find a way to end up in the green. So let's break that down into 4 key parts. First, alternative assets. We're talking about stuff way beyond just stocks and bonds. They might invest in real estate, commodities, private companies, you name it. They use alternative strategies. These are the powerful tools we're about to get into to chase those absolute returns. And finally, the whole show is run by managers and partners who, and this is key, often have millions of their own dollars invested right there alongside their clients. Talk about skin in the game. Okay, so how do they do it? How do they chase those returns? The book uses this fantastic analogy. If a regular mutual fund is like a reliable old propeller plane, a hedge fund is a fighter jet. It's way faster, way more agile, and it has a much, much more sophisticated toolkit at its disposal. And this table here really lays out the differences. Just look at the contrast. Mutual funds, tightly regulated, and they mostly just buy stocks, hoping they go up. But hedge funds, they operate with so much more freedom and way more risk. They can use all these complex strategies. Their fees are tied directly to how well they perform, and you can't just decide to pull your money out tomorrow. It's a totally different ballgame. One of their most famous tools is short selling, which is basically betting that a stock's price will go down. And this is how it works. You find a company you think is way overvalued. You borrow shares of that company from a broker, and then you sell them immediately. Then you wait. If you were right and the stock price tanks, you buy the shares back at that new, super low price, return them to the broker, and wham, you pocket the difference. It's literally selling high and buying low, just in reverse. Another huge one is leverage. And to put it simply, leverage is just using borrowed money to supercharge your bets. So as you see here, a fund might take its $100,000, borrow another $100,000, and suddenly it's got $200,000 of firepower. Now this can absolutely double your gains. But, and this is a big but, it can also double your losses. It's the very definition of high risk, high reward. Okay, so this all sounds pretty powerful, right? But who actually gets to play in this high-stakes game? It is, after all, a very exclusive club. So let's take a look at the price of admission. First off, there's the cost. The standard fee structure is famously known as 2 and 20. What this means is that managers usually charge a 2% fee on all the assets they manage every year, plus they take a 20% cut of any profits they generate. It's a structure that's designed to attract the absolute best talent, people who are confident they can deliver those big returns. And here it is. This is the biggest barrier to entry. Because hedge funds are so loosely regulated, they can only accept money from what are called accredited investors. In the US, that generally means you need a net worth of over $1 million, not including your house, or you need to be making a consistently high annual income. The government's logic is basically you need to be rich enough to handle it if you lose it all. The book brings up this great quote from Groucho Marx, and it's just perfect for this. There's this weird psychology at play, right? The very fact that most people can't get in is part of what makes hedge funds so attractive. It creates this powerful mystique. So why does any of this stuff matter to the rest of us? Well, because hedge funds have grown from this tiny, secret corner of the financial world into a massive, global force that can, and does, impact the entire economy. And this timeline just shows you the incredible explosion. I mean, think about this. It all started with just one guy, Alfred Winslow Jones, back in 1949. For decades, it was a tiny, niche thing. Then in the 90s, huge players like university endowments started investing, which made the whole industry legitimate. And today? Today, we're talking about a 5 times trillion dollar industry. That's trillion with a T. This quote from the legendary Leon Cooperman really sums it all up. Success just breeds more success. The potential for these huge returns attracts the smartest people and the biggest piles of cash, which then creates even more opportunities for big returns. It's a really powerful cycle. So this all leaves us with a big question. Are hedge funds just a high-stakes playground for the super rich? Or are they actually a vital part of the financial ecosystem, helping to stabilize markets and correct inefficiencies? The book suggests the truth is probably somewhere in the middle. But what do you think? It's definitely something to chew on.
Hedge funds. You've definitely heard the term, right? It probably makes you think of Wall Street billionaires and high-stakes finance. But what are they, really? And how are they so different from the mutual funds that so many of us have in our retirement accounts? Well, let's break it all down.
Yeah, this quote from the legendary investor Cliff Asness just nails it. Hedge funds have this mystique about them. They feel like this exclusive club for the super rich and in the know. But if you strip away all that hype, what are they actually doing that's so different? Well, the whole story really starts with a problem.
So picture this. It's 1989. You've got this guy, Lee Cooperman. He is an absolute rock star at picking stocks. He's running a massive mutual fund, but he keeps hitting this wall. He's got this incredible ability to spot companies that are about to tank. But the rulebook for his fund, it only lets him bet on stocks going up.
And that right there is the core dilemma of what we call traditional long-only investing. In a normal mutual fund, you buy stocks and you hope, you pray they go up. That's pretty much the only move you have. It's a fantastic strategy when the market's on a tear, but what happens when things go south? Your only real option is to sell. For a guy like Cooperman, this felt like he was fighting with one hand tied behind his back. He was missing half his toolkit.
This one single question, this changes absolutely everything. It's a complete paradigm shift, moving away from just hoping you can ride the market's waves. The idea here is to figure out how to profit from the ebbs as well as the flows.
And the answer lies in a strategy that is the absolute defining characteristic of a hedge fund. See, while mutual funds go long, which is just a fancy way of saying they bet on a stock's price to rise, hedge funds can also go short. And going short is basically a bet that a stock's price is going to fall. This is their superpower.
To really get this, you have to understand a concept called short selling. Now, I know it sounds complicated, but the core idea is actually pretty simple. You are trying to make a profit from a drop in price. Just think of it like flipping the old saying on its head. Instead of buy low, sell high, you're trying to sell high, then buy low.
Okay, let's walk through this. First, a fund manager finds a company they think is just way overvalued. So what do? They borrow shares of that company, and they immediately sell them on the open market at today's high price. Now, if they're right and the stock price craters, they can buy those same shares back at the new, cheaper price, return them to the lender, and that difference between the high price they sold at and the low price they bought at, that's their profit. It's a way to literally capitalize on pessimism.
But you know, this ability to go both long and short, that's really just the tip of the iceberg. It fundamentally changes how these funds operate. It means they are, for all intents and purposes, playing by a completely different set of rules.
This slide really lays it all out, doesn't it? Just look at the key differences. First row, regulation. Mutual funds, they're for everybody, so they are super tightly regulated. Hedge funds, on the other hand, are only for accredited investors, basically wealthy people who meet certain income requirements, so the regulations are way looser. This leads to huge differences in fees. You've probably heard of the infamous 2 and 20 structure for hedge funds. That's a 2% management fee plus a whopping 20% of all the profits. And then there's liquidity. You can pull your money out of a mutual fund any day of the week, but with a hedge fund, you're often facing lockup periods. That means your cash could be tied up for months or even years.
So, let's talk about that 2 and 20 model. It's pretty controversial, and for good reason. But the logic behind it is to attract the absolute sharpest minds in finance and give them a massive incentive to perform. I mean, think about it. When a manager's pay is directly tied to your profits, and they usually have millions of their own money in the fund right alongside yours, well, their interests and your interests become powerfully aligned. They have some serious skin in the game. Okay, so we've got all of these differences in strategy, fees, and rules, which brings us to the most important question of all, right? Does it actually work? Does this whole different way of playing the game actually deliver better results? Let's take a look at the data.
Now, this chart tells a story. This is where you really see the hedge in hedge fund. During the 2008 financial meltdown, the broader market, the S&P 500, just got obliterated. It plummeted by a staggering 55%. Now, hedge funds lost money too, nobody's denying that. But their average loss was less than half of that. Their ability to short the market acted like a massive shock absorber during one of the worst crashes in history.
Okay, let's fast forward to a more recent, crazy time, the pandemic era. Between 2020 and 2022, a super choppy and uncertain period for everyone, hedge funds, on average, once again edged out the S&P 500. This shows that their strategies aren't just for massive crashes, they can also be really effective in those long, drawn-out periods of market turbulence.
And to really see the long-term impact, just look at this. Let's say you invested $1,000 at the start of the 2000s, a decade that included both the dot-com bust and the 2008 crisis. If you'd put it in the S&P 500, you would have actually lost money. Your $1,000 would have shrunk. In that exact same period, an average hedge fund would have grown your investment by over 40%. The ability to navigate those down markets made all the difference in the world.
So the performance numbers can be really compelling, I get it, but, and this is a huge but, it is so crucial to understand that hedge funds are not some kind of magic bullet. They're complex, they come with much higher fees, and they are definitely not for everyone. As the source material puts it, you have to know thy investing self.
In fact, the source material offers what it calls a Surgeon General's warning for anyone even thinking about going down this road. And the message is crystal clear. This is not a casual investment. It requires a ton of research, the patience to have your money locked up for potentially long periods, and a really honest look in the mirror about your own tolerance for risk. The last point says it all. Research, research, research.
So in the end, the choice isn't really about which one is better, it's about what's right for you. Mutual funds offer a pretty simple, accessible way to invest in the market's long-term growth. Hedge funds offer a much more complex, active strategy designed to generate returns no matter what the market is doing. They are a different tool for a different job, which leaves us with the most important question to think about. What kind of player are you?
Welcome to The Explainer. So today we're going to tackle one of the most powerful and, let's be honest, mysterious forces in all of finance, the hedge fund.
You know, this quote from John Brooks just nails it, doesn't it? Parlor cars of the new gravy train. I mean, it just screams exclusivity, right? It paints this picture of immense wealth, a kind of secret club playing by its own set of rules.
But what is a hedge fund really? And where did this whole idea even come from? Well, to figure that out, we've got to go back. Way back. Long before Wall Street was a thing, before stocks, even before paper money existed.
All right, so Section 1, the first hedge, an ancient blueprint. And you're not going to believe where this story begins. It's not in some high-tech trading pit, but in an olive grove in ancient Greece with a philosopher who decided to make a very unusual bet.
So you've got this philosopher, Thales of Miletus, and he's using his knowledge of astronomy to predict the weather. Pretty advanced stuff for the time. And he sees something nobody else does. A huge, record-breaking olive crop is on the way. And with that little piece of insight, he makes a bet that's completely against the grain. Okay, so let's break this down, because it's brilliant. He pays this small fee up front to the farmers for, and this is the key phrase, the right but not the obligation to rent their presses. Then, boom, the massive harvest hits, just like he predicted. Suddenly, everyone is desperate for an olive press, and guess who controls the entire supply? Thales. He had basically hedged his bet and completely cornered the market. It's the first hedge fund in a nutshell.
All right, Section 2, the Jones model, the architect and the formula. So let's jump forward a few thousand years into the 20th century and see how this ancient idea got a modern makeover from a very unlikely character.
Yeah, so meet Alfred Winslow Jones. This guy was not your typical Wall Street type. He was a former journalist, studied Marxist theory, and even ran missions for an anti-Nazi group. No MBA, no finance background. And yet, in 1949, he takes $100,000 and creates the blueprint that an entire industry is still based on today. Crazy, right?
So, what was his secret sauce? Well, first up, he totally changed how managers get paid. Instead of a flat fee, he took a 20% cut of the profits. But here's the kicker. He also made the managers put their own money into the fund. This is absolutely key. It created what we call an alignment of interests. They had real skin in the game. If you won, they won big. If you lost, they lost too.
Okay, tenet number 2, he basically built a cloak of mystery around the whole operation. By keeping his fund private and relatively small, he flew right under the regulatory radar that guys running mutual funds had to deal with. And that secrecy? It was a massive strategic advantage. It gave him the freedom to use all sorts of financial tools that were totally off limits to everybody else.
And this brings us to the real magic trick, the core of his strategy: short selling plus leverage. So he'd buy stocks he thought would go up, that's called going long. But at the same time, he would short sell stocks he thought would go down. Basically, you borrow a stock, sell it, hope the price drops, then buy it back cheaper and pocket the difference. The whole point was to make money whether the market was going up or down. And then he'd use leverage, borrowed money, to juice those returns even more.
So what happened when you put all that together? The results were, well, they were just staggering. Jones's original fund delivered a cumulative return of 5,000%. He hadn't just made a fund, he had created a machine for generating insane amounts of wealth. All right, Section 3. Titans of Wall Street, the Golden Age. So once a formula that's successful is out in the wild, you know it's not going to stay secret for long. It didn't, and that kicked off what a lot of people call the Golden Age of hedge funds.
You know, the industry's early years were pretty wild. There was this initial boom, but then a market crash in the 70s nearly wiped the whole concept off the map. People thought it was just a fad. But then came the 1980s, and a whole new generation of superstars emerged, and they were taking on bigger, bolder, and more global bets than anyone had ever imagined. And these new titans, they were playing on a totally different level. They took the Jones model and scaled it up globally. The most famous example, of course, is George Soros in 1992. He made this enormous bet that the British pound was way overvalued. So using a ton of leverage, his fund just hammered the currency, shorting it so aggressively that it actually forced the British government to devalue it. I mean, think about that, a single fund taking on an entire country and winning. And the payoff for that one single trade? Soros's fund walked away with over $1 billion in profit. It was this incredible transfer of wealth, really, from a nation's taxpayers right into the pockets of a single hedge fund.
And it wasn't just Soros. You had other legends, like Julian Robertson. He built his own empire, the Tiger Fund, by absolutely perfecting that original Jones model. But his legacy goes even deeper. His fund became this legendary training ground, producing a whole generation of incredible managers who became known as the Tiger Cubs, and they went on to basically dominate Wall Street for years to come.
Okay, Section 4, when geniuses fail. Hubris and humbling. But here's the thing. When you're making astronomical bets with incredible leverage, the flip side is the risk of an equally spectacular collapse. And when these geniuses fail, man, they can threaten to take the whole system down with them. So this is really interesting because it shows you two sides of the same dangerous coin. On one side, you've got long-term capital management, LTCM. This place was run by actual Nobel Prize-winning economists, super complex models, leveraged 70-1. But when Russia unexpectedly defaulted on its debt in '98, their perfect models just shattered. The Fed had to step in and orchestrate a massive bailout to stop a global meltdown. Then, on the other side, you have something much simpler, Amaranth Advisors. Here it was just one trader who made a gigantic bet on natural gas prices. The hurricane he was betting on never showed up, the price collapsed, and the fund lost $6 billion in 1 week. And Warren Buffett, as usual, had the perfect line for it. You only find out who is swimming naked when the tide goes out. These crises, they just pulled the curtain back, they revealed just how much insane risk was hiding under the surface, and, maybe more importantly, how deeply interconnected the entire global financial system had become.
All right, our final section, Lost and Found, the Modern Era. So after surviving all these storms plus the big one in 2008, the hedge fund world entered this really strange new phase, one that really tested its whole reason for existing.
Yeah, the 2010s got slapped with the label the lost decade for hedge funds. Their growth just slowed to a crawl, and they were getting squeezed from all sides. You had tighter regulations after the financial crisis, more competition from cheaper index funds and mutual funds, and, this is the big one, a long, steady bull market. I mean, for years, the market just relentlessly went up. So why would you pay a fund manager massive fees to hedge your risk when there was seemingly no risk to hedge against? But then, 2020 happened. The pandemic, the lockdowns, sharp market crashes, just intense economic uncertainty. And all that chaos was a pretty stark reminder of what these funds were originally created for. In a world where it feels like anything can happen, the ability to protect your money from big losses and actually find opportunities in all that volatility, well, suddenly that skill set was back in very high demand.
And that really leaves us with a final question to chew on. As our world seems to get more complicated and more unpredictable by the day, could it be that these exclusive, secretive parlor cars of the gravy train, an idea born from a simple bet on an olive harvest thousands of years ago, could they be more essential now than ever before?
Hedge funds. For the longest time, they were this super exclusive club, just for the mega rich, a really secretive part of the financial world. But who really gets to invest in them today? Well, the answer has changed a lot, and it might actually surprise you. So let's get into it.
But before we get into the weeds, let's start with a really basic question about us, about people. What is one of the absolute best ways to make somebody want something? Like, really, really want it?
It's so simple, it's almost funny. You just tell them they can't have it. Seriously, it's this fundamental quirk in our psychology. The second something is off limits, it's suddenly the only thing we can think about.
The comedian Groucho Marx had this amazing line that just hits the nail on the head. And that idea that the exclusivity is the main attraction, that is the key to understanding why hedge funds were so alluring in the first place. They weren't just an investment, they were the ultimate members-only club.
All right, so for most of their history, hedge funds ran on this exact principle. I mean, they were designed to be hard to get into, and that's exactly what made everyone want in.
A really good way to think about it is like they were financial speakeasies during Prohibition. Seriously. They were private, they operated way outside of the public eye, and you basically had to know a guy who knew a guy just to get in the door. And all that secrecy, it created this whole aura of mystique and prestige. And when I say this world was small, I mean it was tiny. We're talking about maybe 3,000 investors in total, spread across just 150 funds, all of it happening in secret, out of public view. And the buy-in, it was huge. You needed at least $500,000, maybe up to $10 million just to get a seat at the table. The client list wasn't just a bunch of rich people, it was a who's who of the era. We're talking Hollywood royalty like Jimmy Stewart and Lana Turner.
Okay, so this exclusivity wasn't just some marketing gimmick, it was actually written into the law. Let's take a look at the rules that kept the doors to this club slammed shut for pretty much everyone.
So the main gatekeeper here is a term you'll hear from the SEC, the accredited investor. Now, officially, the idea is that these are people who are financially sophisticated enough to understand and handle high-risk, unregulated investments. But let's be real. What it really boils down to is being rich enough to take a massive loss and not have it ruin your life. And just look at how high that bar is. If you're an individual, you've got to have a net worth of over $1 million, and that doesn't even count the value of your main house. Or you have to be making over $200,000 a year. For an institution, like a charity or a bank, it's at least $5 million in assets. I mean, this test effectively locked the door and threw away the key for almost everybody. But then, the unthinkable happened. Right at the turn of the millennium, this whole exclusive world was teetering on the edge of collapse. And just when it looked like the party was well and truly over, a hero showed up from a very unlikely place.
The year is 2000. The dot-com bubble is bursting, and things are getting chaotic. Two of the absolute legends of the business, George Soros and Julian Robertson, are actually shutting down their giant funds. Soros himself said the markets had become extremely unstable. The future of the entire industry was seriously in doubt.
And right then, this magical fairy godmother, as one writer put it, arrived to save the day. But here's the twist. It wasn't some Wall Street hotshot. It was a guy named David Swensen, and he was the manager of Yale University's endowment. And his next move would change absolutely everything.
Swenson's story is just incredible. He takes over Yale's endowment back in '85, and he's pretty cautious at first. It took him 5 whole years before he made his big play, but in 1990 he did it. He invested a whopping $300 million into a hedge fund, and the result? Just wow. By 2005, those investments alone had made Yale $7.8 billion. He proved that an institution could not only play this game, but could win, and win big.
So, Swenson's big win didn't just pad Yale's accounts. It basically saved the entire hedge fund industry and kicked off this massive, massive change. This was the start of what we call the institutional takeover.
Okay, to really get a sense of just how big this shift was, let's look at the money. Back in 1990, when Swenson first jumped in, the total amount of cash in all hedge funds, everywhere, was just under $39 billion.
Now, you ready for this? Fast forward to today. That number hasn't just grown. It has exploded to nearly $5 trillion. That kind of growth is just mind-boggling, and it was driven almost entirely by other big institutions seeing what Yale did and jumping on the bandwagon. So what does this exclusive club look like now? Well, that original who's who list of super-rich individuals, they now only account for about a quarter of all the money in hedge funds. The overwhelming majority, a full 75%, is now controlled by institutions. The club's membership has been totally flipped on its head.
Okay, so at this point, you might be thinking, all right, cool story, but what on earth does this have to do with me? Well, this is the part where the story of hedge funds stops being about the lifestyles of the rich and famous and starts being about, well, all of us.
See, the key thing to understand is what these institutions actually are. We're talking about university endowments that pay for scholarships. We're talking about the public and private pension funds that are supposed to manage your retirement money. We're talking about charitable foundations that do all sorts of critical work. So, while you probably don't have a direct investment in a hedge fund, there's a very good chance your money does indirectly.
And why are they all doing this? It's simple, the returns. I mean, just look at this. In 2021 alone, Harvard's endowment, which is heavily invested in alternatives like hedge funds, returned a mind-blowing 33.6% in a single year. These are the kinds of massive gains these institutions need to fund their missions.
And this has a very, very real impact. Studies have shown that even a small investment in hedge funds can boost a pension fund's returns by about 1.5 percentage points every single year. Now, that might not sound like a lot, but in an age where so many pensions are underfunded, that extra return is absolutely crucial for the retirement security of millions of people. Teachers, firefighters, public workers, you name it.
Which brings us to this final, really fascinating question. You have an industry that was built from the ground up on secrecy and exclusivity for a tiny handful of elites, and now it's become a fundamental pillar supporting our collective financial future. So now that these old financial speakeasies are holding the keys to our pensions and our kids' scholarships, what should come next? What does that mean for transparency, for regulation, and for access?
You've probably heard the phrase, heads we win, tails you lose, right? Well, it perfectly sums up the whole controversy and, let's be honest, the allure of the hedge fund world. And today, we're going to tear apart one of the most famous, and yeah, notorious, fee structures in all of finance.
But here's the thing. Is all that criticism really fair? This quote from Sebastian Malabai, it kind of frames our whole conversation today. He says, sure, the complaints seem plausible. That is, until you actually stop and look at the alternative. It really makes you think, maybe this system, with all its crazy flaws, is actually the best we've got. And just to give you a sense of the scale we're talking about here, picture this. It's January 2007, New York City. 20 of the most powerful hedge fund managers on the planet are all sitting down for dinner. Now, what they talked about, who knows? But the amount of money they controlled? Wow. We're talking nearly $200 billion, all managed by the folks in that one room. That's the kind of insane wealth this fee structure can generate.
Okay, so here's how we're going to break this all down. First, we'll get into the nitty-gritty of that notorious 2 and 20. Then, we'll look at why critics call it a grotesque arrangement. After that, we'll flip the coin and explore the defense, this whole idea of having skin in the game. We'll also touch on some protections for investors, and then finally, we'll ask the big question, is the performance actually worth the price?
All right, first up, the notorious 2 and 20. Let's just dive right in and figure out where all this money is actually coming from.
So, the classic 2 in 20 model. It's really made up of two parts. First, you've got a management fee.
This is usually around 2%, and it's charged on the total amount of money in the fund every single year. Then part 2, you have the performance fee. That's a whopping 20% slice of any profits the fund makes.
You know, theory is one thing, but seeing the actual numbers really brings it to life. So let's walk through a super simple hypothetical example. We'll use a made-up fund, let's call it We Rock Asset Management, just to see how this all plays out for you, the investor. Okay, so let's put you in the driver's seat. You're the investor, you've got a cool $1 million, and you are ready to put it to work. So you hand it over to the fund.
And boom, the second that money is in, the clock starts ticking on that management fee. For our example, we'll say it's 1.5%, which works out to $15,000. Now, this is absolutely crucial. That fee gets paid whether the fund makes money, loses money, or just sits there doing nothing. It's the guaranteed paycheck for the manager.
Okay, now let's say the manager has an absolutely fantastic year. I mean, they knock it out of the park. They generate a 20% gross return on your $1 million. That's a $200,000 profit before any other fees come out.
And this is where that second fee kicks in. The manager now gets to take their 20% cut of that $200,000 profit, so that comes out to a $40,000 performance fee. That's their big reward for having such a successful year.
So let's do the math. You take the $200,000 profit, subtract that $40,000 performance fee, and what are you left with? Your net return is $160,000. Hey, you made great money, for sure. And the manager? They were compensated very well, taking home $15,000 in management fees plus another $40,000 for performance.
And this right here brings us to the big critique. Is this whole structure actually fair? Well, a lot of people, including some of the heaviest hitters in finance, would give you a hard no. They've called it, and this is a quote, a grotesque arrangement.
And really, who better to make that case than the Oracle of Omaha himself, Warren Buffett? He does not mince words here, calling it a totally lopsided system. His point is brutally simple. You pay the manager even if they lose your money. And that, right there, is the heart of the whole heads they win, tails you lose argument.
But the criticism wasn't stopped there. This next quote, man, it's even sharper. Some critics have labeled the whole thing a compensation scheme dressed up as an asset class. Oof. That's basically saying this isn't about investing, it's just a clever way for managers to get paid.
So, okay, that's the case against 2 and 20. It's pretty compelling, right? But what's the defense for this, for this seemingly lopsided structure? It really all boils down to one very powerful concept: skin in the game.
So why the high fees? Well, the people who support it have 4 main arguments. First, they say it aligns everyone's interests. The managers have a ton of their own money in the fund. They're eating their own cooking, so to speak. They win when you win, they lose when you lose. Second, these fees cover the massive overhead. We're talking offices, lawyers, accountants, the whole shebang. Third, that big paycheck? It attracts the sharpest minds in the business. And finally, it gives managers a huge incentive to go out there and hunt for those truly superior, market-crushing returns.
So really, you've got 2 completely different stories here. On one side, the critics see a system that basically guarantees managers get rich, even if it slowly eats away at an investor's wealth. But on the other side, the supporters see a system that lines up everyone's interests, gets the best talent on board, and, has the potential to generate absolutely mind-blowing returns.
But is it a total free-for-all for the managers? Well, not exactly. There are a couple of key things often built into the agreements that are designed to give investors, like you, a little bit of protection.
The first one is called the high watermark, and this is a really big deal. Let's say your investment drops from $1 million down to $800,000 one year. Well, the manager can't charge you a performance fee the next year just for getting it back up to $1 million. No way. They have to push the fund's value past its previous peak to a new all-time high before that 20% performance fee kicks back in.
And the second protection is something called a hurdle rate. This basically means the fund has to hit a certain minimum return, let's say 5%, before the manager can even start taking their performance fee. So if the fund only squeaks out a 4% return, the manager gets 0 performance fee on that gain. They actually have to clear a bar to get their big payday.
Okay, so we've weighed the critiques, we've heard the justifications, we've looked at the protections, and it all boils down to one single question. Do the results actually justify the costs? I mean, is the juice really worth the squeeze?
I mean, just look at these numbers. The power here is, well, it's kind of undeniable. Take this historical example. Between 1967 and 1995, if you'd put $100 in the S&P 500, it would have grown to about $1,700.
Not bad, but that same $100 in the fund of a legendary manager like Michael Steinhardt, it would have exploded to over $46,000. Now that is the kind of mind-blowing outperformance that, in the eyes of supporters, makes any fee totally worth it.
And just for a final kind of ironic twist, let's go back to Warren Buffett, the fee structure's biggest critic. Well, it turns out that early in his career, he actually ran his own investment partnerships that, well, they looked an awful lot like the hedge funds he'd later criticize. It's just a fascinating little wrinkle that shows you how complex this whole debate really is. So where does that leave us? Is the 2 and 20 model the necessary price you have to pay to unlock financial genius? Or is it just an outdated, lopsided relic from the past that's slowly being replaced by better models? You know, that debate is far from over. But one thing is for sure, the answer to that question is going to keep shaping the future of high finance for years to come.
All right, let's jump right in. For centuries, people have gone on these legendary quests chasing mythical treasures. Well, today, we're on a pretty similar journey, but our destination, it isn't some lost city of gold. It's something way more elusive, and honestly, for some people, a whole lot more valuable. Welcome to the Alpha Game. Edgar Allan Poe just nailed the feeling of a doomed, but, really noble quest. The search for El Dorado. This mythical city of gold that led so many brave souls straight to ruin. It's such a powerful metaphor for that endless, all-consuming search for something that, well, might not even be real. So, what on earth does a 19th century poem have to do with finance? Well, in the world of high-stakes investing, in the world of hedge funds, there is an El Dorado. There's a legendary prize that managers journey long and hard and risk everything to find. And that prize, it's called alpha. Alpha is the ultimate treasure. It's the ability to generate returns based purely on skill, completely independent of whether the stock market is soaring or crashing or just going sideways. It is the proof that you're not just lucky, you're actually good.
And the parallels, they're pretty striking, right? Just like the quest for El Dorado, the hunt for alpha is just littered with failures. So many have tried and so many have met with, frankly, colossal disappointment and financial ruin, all in their search for these absolute returns. Now, to really get what this quest is all about, we gotta learn the language. Think of it as our own secret code. So let's get into the key vocabulary. Let's learn the alpha-beta song.
So, alpha, it's a measure of pure skill. Let me put it this way. If the market is totally flat, it does nothing, and your fund returns 2%, that 2%, that's your alpha. It's the value the manager adds that has absolutely nothing to do with what the market's doing.
And then you've got alpha's much more common sort of red-headed stepsister, beta. Beta just measures how much a fund moves with the market. So if the market has a beta of 1, a fund with a beta of 2 is twice as volatile. It's just riding the market's waves, not making its own.
And at the heart of both alpha and beta is this idea of volatility. At its core, volatility is really just a fancy word for risk, the ups and downs, the turbulence you feel in your investment journey. The whole point of finding alpha is to get those returns without all that stomach-churning volatility.
And this really gets to the core of it, doesn't it? Alpha is about skill, forging your own path. Beta is just about riding the market's coattails. Hedge fund managers get paid the big bucks to find you alpha, not to give you beta, because you could get beta from a super cheap index fund. Okay, so how do they even start looking for alpha? I mean, where do you begin? Well, it starts with a map, a theoretical framework for navigating the markets. So let's take a look at the theory that created this map in the first place.
Our maps started getting drawn up back in the 1950s. First, a guy named Harry Markowitz said, hey, it's not just about maximizing returns, it's about maximizing risk-adjusted returns. Then William Sharpe came along and simplified things, and James Tobin added the last piece of the puzzle. Together, they gave us modern portfolio theory, what some people call the closest thing to a free lunch in economics.
Now, the absolute key to reading this map is understanding one little word, correlation. It's just a number between -1 and +1 that tells you how two different investments move in relation to each other. I'm telling you, this one concept is the absolute foundation of managing risk. So if two investments have a correlation of +1, they're like two peas in a pod. They move in perfect lockstep. One goes up, the other goes up. Holding both of them doesn't really do much to reduce your risk at all. But if their correlation is -1, now you've got a perfect seesaw. When one side goes up, the other side goes down. This is the holy grail of risk management, because when you pair these investments up, their movements can actually cancel each other out, which really smooths out your returns.
So how do managers actually use this stuff in the real world? Well, it's kind of like trying to drive with one foot on the gas and one on the brake at the same time. You're using diversification to control the ride.
The logic is actually pretty simple. You find investments that don't move together. You know, your seesaws. You balance them out. You throw in some alternative assets like real estate or commodities, things that march to the beat of a different drum. And the ultimate goal? That free lunch we talked about. Higher returns with less risk. It's really just the grown-up version of don't put all your eggs in one basket. But, and this is a huge but, here's the catch. Sometimes the map is just wrong. The theories that look so perfect and elegant on paper can totally fall apart in the real world. This quest for alpha is absolutely filled with hidden dangers.
I mean, as Warren Buffett famously warned us, beware of geeks bearing formulas. Relying too much on these slick mathematical models can be incredibly dangerous because at the end of the day, markets are driven by people. And people, we can panic in ways that no formula could ever predict. In fact, if you do it poorly, diversification can actually make things worse. Yep, welcome to the idea of diversification, where your clumsy attempts to reduce risk actually end up torpedoing your portfolio.
And the real-world dangers are no joke. During the 2008 crisis, investors learned a brutal lesson. In a true panic, all correlations go to one. Suddenly, everything goes down together. Even a legend like Julian Robertson of Tiger Management admitted that sometimes diversification just isn't enough. And if you overdo it, you just dilute your best ideas and end up looking like everybody else.
So, if diversification can fail you and the map is flawed, what's the point? What is the real treasure at the end of this whole quest? Let's get to the real bottom line. You've really got two schools of thought. Mark Twain's advice is fantastic for building a fortune. Concentrate, put all your eggs in one basket, and watch that basket. But for a hedge fund manager who's trying to protect and grow enormous wealth, that's just way too risky. Their job demands a much more complex path of taking calculated risks to protect capital and make it grow. So, in the end, alpha isn't El Dorado. It's not a myth. It is incredibly rare, and it is brutally hard to find. But it is real. It's the result of a deliberate process. It's a combination of skill, strategy, and just really intelligent management of risk. It's a place where money can actually be preserved and grown.
Which leaves us with one final thought. We've got the formulas, we've got the theories, we've got all the data. That's the science. But we also know that when a crisis hits, it all comes down to conviction, common sense, maybe even a little bit of gut instinct. So what do you think? Is this epic quest for alpha ultimately an art or a science?
You know, for decades, this one powerful theory totally dominated finance. It said the market was perfect, it was rational, and it was absolutely unbeatable. But if that's actually true, how did an entire industry of hedge funds just spring up with the single goal of, well, beating it? This is the story of how that perfect theory came crashing down and what rose up from the ashes.
This quote right here, it just perfectly captures the whole puzzle we're going to unpack. It's a little hint that maybe the theory itself was, well, let's just say it was on some seriously shaky ground. So what exactly was this big idea that for a while everyone thought was rock solid? Okay, let's start at the beginning with the big idea that set the stage for everything that followed, the myth of the perfect market.
So back in the 1960s, an economist named Eugene Fama came up with something called the efficient market theory. And the gist is actually pretty simple. At any given moment, a stock's price already reflects every single piece of public information about it. The news, the earnings reports, the rumors, you name it, it's all baked right into the price. Now, here's where it gets really interesting. If all the old information is already priced in, that means any future price change can only come from new information. And new information, by its very nature, is unpredictable. So what does that mean? It means skill, analysis, brilliant strategy. None of it really matters. Any success you have is just pure luck. In this, as you can imagine, led to a pretty wild conclusion about all the so-called experts on Wall Street. I mean, if success is totally random, then a highly paid fund manager is theoretically no better at picking stocks than, well, you've probably heard this one before. And there it is,
That famous line from Burton Malkiel's classic book, A Random Walk on Wall Street. It just brilliantly gets to the heart of the idea. In a truly perfect, efficient market, the pros, the stock pickers, they don't really add any value.
So here's the huge contradiction. If this theory is true, the entire concept of a hedge fund, a company dedicated to using skill and strategy to find an edge, it's a logical impossibility. They just shouldn't even exist. But they do. So what gives? Well, what gives is that the real world was about to deliver a massive shock to the system, one that sent this neat and tidy theory into a complete tailspin. Just picture the mid-1980s. It was the great go-go stock market era. I mean, from 82 to early 87, the market had doubled. Everyone felt like a genius. And then, on one single day, October 19th, 1987, a day we now call Black Monday, it all just fell apart. The market lost almost a quarter of its value in one day. And the crazy part? There wasn't some single piece of catastrophic new information that could explain a drop this massive, this sudden. It just happened. And that was the question that suddenly everyone, including the theory's own creator, Eugene Fama, had to ask themselves. If the market is this perfect, rational machine, how did it just have a complete and total meltdown? The answer wasn't in the spreadsheets. Turns out, the answer was in us. The crash revealed this hidden variable that the original theory had pretty much totally ignored: raw, unfiltered human emotion. Yeah, it turns out that markets aren't just driven by information. They're driven by human feelings. Greed, fear, overconfidence, pure panic. These things aren't always logical. In fact, economists started to realize that we humans are often, predictably irrational. So why are we like this? Well, it kind of boils down to a few very human things. First, you've got good old-fashioned greed and fear, which can totally cloud our judgment. Then there's overconfidence, that little voice in our head telling us that, yeah, we're the genius who can time the market perfectly. And finally, believe it or not, brand snobbery. We chase after those big, flashy, famous stocks while completely ignoring the hidden gems that might actually be the better bet. To help make sense of this emotional roller coaster, the legendary investor Benjamin Graham, the father of value investing, came up with this brilliant analogy. He invented a fictional business partner to represent the market's wild mood swings, and he called him Mr. Market. And this just nails the opportunity, doesn't it? Some days, Mr. Market is euphoric, practically manic, and he'll offer to sell you his shares at ridiculously high prices. But on other days, he is panicked and depressed, and he's willing to sell you those exact same shares for pennies on the dollar. So, the job of a smart investor is to ignore his mania and take full advantage of his fear. This irrationality is what creates opportunity. So, once academics realized the market wasn't a perfect machine, but had this personality, the race was on to find and map all of its predictable patterns and flaws. And here is one of the greatest plot twists in economic history. The guy who led the charge to find the flaws was Eugene Fama himself, the man who created the theory. He and his colleague, Kenneth French, started diving headfirst into the data, hunting for the very anomalies his original theory said couldn't possibly exist. And what did they find? Oh, they found some real patterns. They saw that over time, those overlooked value stocks tended to outperform the popular, flashy growth stocks. They also found that smaller companies often did better than larger ones. And later, other researchers found even more stuff, like how low volatility or more stable stocks, and even simple price momentum could help predict performance. All of a sudden, the perfect market looked like it was full of exploitable cracks. All right, so with the map of the market's flaws now in hand, an entire industry was ready to jump in and start taking advantage of them. This right here is the modern hedge fund's whole reason for being. Their entire business model is to find those moments when Mr. Market is being irrational, when a stock is mispriced because of too much fear or too much hype, and then make a bet that sanity will eventually return. You could say they exist to iron out the market's emotional kinks. So how do they actually do it? Well, a classic strategy is called the long-short trade. Let's say a manager finds two competitors. They think stock A is a total bargain, so they buy it. That's called going long. At the same exact time, they think its competitor, stock B, is way overvalued. So they borrow shares of stock B and sell them. That's shorting it, betting its price will fall.
The goal is to profit from the difference between the winner and the loser, no matter which way the overall market is heading. This academic proof, this buy-in that markets were not perfect, was a total game changer. It transformed hedge funds from being seen as these risky speculators into legitimate, systematic investment vehicles. All of a sudden, huge, respected institutions like the endowments for Yale and Harvard got the green light to invest, and a flood of money just poured into the industry.
Which really leaves us with one last fascinating question to chew on. The old theory saw the market as a perfect cold machine, but the new understanding sees it more like a massive barometer of our collective hopes, our fears, and all our biases. And if that's true, then maybe the biggest risk we face as investors isn't some sudden market crash, but our own predictable irrationality.
You've probably heard the term hedge fund thrown around, right? It's always connected to crazy wealth and Wall Street secrets. But what if I told you their entire goal is basically to break the #1 rule of investing? Let's crack the code on how these funds are built to make money even when it feels like everyone else is losing.
Think about it. The whole idea behind a hedge fund starts with this one kind of radical question. For most of us, if the market tanks, our 401k tanks right along with it. It's just how it works. But what if you could actually defy that financial gravity? What if there was a way to find profit right in the middle of all that chaos?
And this is the core promise. This is the whole game. Hedge funds aren't just trying to do a little better than the S&P 500. They're chasing something called absolute returns. That's just a fancy way of saying their goal is to make money whether the market is booming or totally crashing. It's that relentless focus on profiting in any environment that makes them a completely different beast.
So how in the world do they even attempt to pull this off? Well, it all comes down to a playbook, a set of 4 core strategies. This is their toolkit for hunting down returns no matter what the rest of the market is doing.
Okay, so this chart here is basically our roadmap for the hedge fund universe. You can see the 4 main strategies: long/short, relative value, event-driven, and directional. They're all major players in the game. Let's break them down, starting with the big one, the one you've probably heard about.
All right, first up, long/short equity. This is like the classic hedge fund move. The easiest way to think about it is playing both offense and defense at the same time. You're betting on some companies to win and other companies to lose, all in the same portfolio.
The idea itself is actually brilliantly simple. A fund manager goes long, that just means they buy stocks they think are going to go up, but at the same time they go short on stocks they believe are headed for a fall. Now, if they get their picks right, they can make money based purely on their skill, not on which way the market happens to be swinging. They're canceling out the market's noise. They are hedging.
Now, that whole short position is the secret sauce here, and it's a totally different way of thinking. You know how we all try to buy low and sell high? Well, short selling is the exact opposite. You're trying to sell high first and then buy it back low later. You are literally placing a bet that a company will fail. Let's see how that works.
So let's make this real. Imagine you think a Maya Hotel stock is just way overvalued at $150 a share. So you borrow 100 shares from a broker and you immediately sell them on the market for $15,000. A few months go by and you were right. The stock tanks down to $50. Now you can buy back those 100 shares for just $7,500. You return the shares you borrowed and you just pocketed a cool $7,500 profit.
But, and this is a huge but, here's the terrifying part. What if you were wrong? What if that stock didn't fall? What if it soared to $250? You still have to buy back those shares to return them, but now it costs you $25,000. You just lost 10 grand. See, when you buy a stock, the most you can lose is your initial investment. But when you short a stock, there's no limit. Your potential loss is theoretically infinite.
Okay, our next couple of strategies are a bit different. They're less about the big picture and more about being financial detectives. They're all about finding profits in really specific situations. You know, in the little cracks and nooks of the market created by big corporate shakeups.
So relative value, which you'll sometimes hear called pair streeting, is a cool one. Here the manager honestly doesn't care if the market is up or down. They're looking for 2 related things, like 2 rival companies, and they're betting on the price difference or the spread between them. The whole goal is to profit when that gap between their prices eventually closes.
For instance, a manager who's an expert in healthcare might think Wyeth is a way stronger company than its rival, Pfizer. So what do? They go long on Wyeth, betting it will rise, and they short Pfizer, betting it will fall. Now, their profit or loss depends only on Wyeth doing better than Pfizer. It doesn't matter what the whole pharmaceutical industry does.
Event-driven strategies are kind of similar, but they're laser-focused on huge corporate events. Think of these managers as investigators. They're trying to figure out if a big merger is actually going to happen or how a bankruptcy will play out. And then they pounce on the weird price movements these events create.
A classic example is something called merger arbitrage. Let's say Wolf Your Cosmetics is trading at $10 a share. Suddenly, another company bids to buy them for $20 a share. The stock instantly shoots up, but maybe only to $16, because there's a risk the deal might fail. An event-driven manager who's done their homework and thinks the deal is solid will swoop in and buy at 16. If the deal closes at 20, they make $4 a share. But if the deal falls apart, the stock could crash right back down to 10 and they lose $6 a share. It's a huge gamble, all riding on a single outcome.
And that brings us to our fourth and final category, directional strategies. Now, if the other strategies are like using a scalpel, this one is like swinging a sledgehammer. These are massive, high-stakes bets on the direction of entire global markets.
These managers, they're called global macro managers, are basically playing 4D chess with the world economy. They're analyzing everything from politics to interest rates to make a huge call. And if they believe, say, a country's currency is about to collapse, they'll make enormous leveraged bets to profit from it. And by leveraged, I mean they're using borrowed money to make their bets even bigger. For them, currencies, oil, interest rates, anything and everything is on the table. And you just can't talk about this strategy without mentioning the most legendary trade of all time. Back in 1992, George Soros and his fund made a massive bet against the British pound. The bet was so huge, it actually helped force Britain to make a major economic policy change. And the profit? The reports say it was around $2 billion. That single trade is what really put hedge funds on the map for everybody.
So, we've looked at 4 really different playbooks, right? We've got the surgical stock pickers and the global big swingers. But at the end of the day, they are all chasing the exact same thing. They are all on a quest for one single, almost mythical concept in finance. It's called alpha. Now, to really get what alpha is, you first have to understand its counterpart, beta. Beta is easy. Beta is just the return you get because the market went up. You know the saying, a rising tide lifts all boats? Well, beta is the tide. If the whole market goes up 10% and your portfolio goes up 10%, that's all beta. You just got lucky by being in the market. Alpha, on the other hand, alpha is different. Alpha is the extra return that a manager generates through their pure skill, their strategy, their genius, and it has nothing to do with what the market did. This is the holy grail. This is the hedge in hedge fund. It's the value that a manager supposedly creates out of thin air, and it's what justifies their entire existence, and of course those insane fees. So if you remember one thing, let it be this. Beta is just market luck. Alpha is pure manager skill. Beta is what you get for just showing up to the party. Alpha is what you get from a manager smart enough to make money even if the party's a total bust. The entire point of hedging is to try and get rid of that random beta luck, to isolate that pure skill-based alpha.
And all of this leads us to the final billion-dollar question. Pulling off these strategies is incredibly complicated and expensive, which is why hedge funds charge such enormous fees. So for the investors who can actually get in, is that difficult, expensive, and often frustrating hunt for a manager's elusive alpha really worth the price of admission?
All right, we're going to talk about a term you've definitely heard thrown around, a force that's quietly changing everything, from the songs on your playlist to the building you might live in. We are talking about private equity.
So what is it really? And what does it actually do? You hear these phrases like leveraged buyouts, and it all sounds super complex and secretive, but honestly, it's not as complicated as you might think. We're going to break it all down.
And to get our heads around it, we're going to start with a really simple idea, a little pitch for a tiny motel that pretty much explains the entire game.
Okay, let's dive in, and forget about multi-billion-dollar deals for just a minute. Believe it or not, the key to understanding the whole private equity playbook, it starts with one little rundown house.
Here's the plan. It's super simple. Step 1, you buy a tiny house for 10 grand. Step 2, you spend another 5 grand to fix it up. You know, make it look good. Step 3, you expand. You start buying up the properties next door. And then the final step, the big payoff, after about 5 years, you sell the whole improved complex for $1 million. Buy, improve, expand, sell. That's it. That's the basic playbook right there.
Okay, so now that we've got the tiny motel concept down,
Let's scale it up. I mean, way up. Let's see how this works in the real world. So on the left, you've got our little mooch motel, but on the right, you've got the real-world version, a private equity firm called Blackstone buying Hilton hotels for $26 billion. See? It's the exact same strategy, just on a totally different scale. Instead of fixing up a kitchen, they're restructuring the entire company's management and tech.
Right, so you're probably asking, how on earth do you buy a $26 billion company? Well, you do it with something called a leveraged buyout, or LBO. This is the absolute bread and butter of private equity. It just means you use a ton of borrowed money, that's the leverage, to buy the company. It lets you make these huge purchases with a surprisingly small amount of your own cash. And hey, when this works, it can be a massive success. Blackstone bought a Hilton that was kind of struggling back in '07, took it private, fixed it up, and then took it public again 6 years later in a huge IPO. It's a similar story for Burger King, PetSmart, Albertsons. All these huge brands were bought, restructured, and then came back to the market, often in much better shape.
But here's the thing. This isn't just some abstract financial game happening on Wall Street. Private equity has become a massive part of our economy, and it probably plays a much bigger role in your daily life than you even realize.
And let's start in a place you would probably never expect to find it, your daily music stream.
I mean, just think about this. Bruce Springsteen's legendary catalog? Yeah, it was sold for around $500 million. Bob Dylan, Neil Young, David Bowie? Same story. And we all remember this saga with Taylor Swift's original catalog, right? It famously ended up with a private equity firm. Your favorite songs have literally become financial assets.
And it goes so far beyond your playlist, it's actually woven deep into the fabric of your everyday routine.
The apartment building you live in. It could be owned by a company controlled by Blackstone, a doctor's visit, or heaven forbid an ambulance ride. The company sending the bill might be owned by KKR. Even the insurance you buy, the food you feed your dog, and in some towns, the very water coming from your tap. Yep, private equity has a massive footprint in all of these industries.
Now, as you can probably imagine, this much influence has led to two very different opinions on the industry. So what's the deal here? Are these firms heroes or are they villains?
So on one side, you have advocates like the late David Swensen, who was a legendary investor at Yale. He called this whole model a superior form of capitalism. The core idea is that these firms are specialists. They're experts who come in, make a company leaner, more efficient, and ultimately more profitable. And then you have the complete opposite view. Author Gretchen Morgenson compares them to modern pirates who plunder businesses not with swords, but with spreadsheets and debt, leaving a mess behind them.
So let's break that down. The pro argument is that taking a company private gives it breathing room. It can restructure without the constant pressure of hitting quarterly numbers for Wall Street. But the con argument says these firms often use aggressive cost-cutting that can lead to layoffs, worse service, and sometimes even bankruptcy for the company, all while the private equity partners still walk away with a profit. The most famous example is probably the collapse of Toys R Us, which a lot of people blame on the massive debt its private equity owners loaded onto it.
So, hero or villain? Whichever side you land on, one thing is absolutely undeniable. Private equity is fundamentally reshaping our entire economic landscape.
And the scale of this change is just staggering. In a single decade, from 2012 to 2022, the amount of money managed by these firms more than doubled, ballooning from $2 trillion to over $4.4 trillion.
Now, this explosion in the private world has had a direct and pretty shocking consequence. The traditional public stock market, the one where anybody can invest, is actually shrinking.
Just chew on this for a second. Back in 1996, there were about 8,000 companies listed on the U.S. stock market.
Today, even though our economy has grown by trillions and the population has jumped by 70 million people, that number has been cut in half. There are fewer than 4,000 public companies left. A huge chunk of our economy has moved from public ownership into private hands.
And this all leads to a really critical question. See, this shift from public to private is also a shift away from public scrutiny and a lot of government oversight. So as more and more of our economy operates behind this private curtain, we have to ask ourselves, who gets to look under the hood?
All right, let's dive right in. Today, we're pulling back the curtain on how to pick a hedge fund manager. And look, this isn't just about picking some stocks. It's about picking the person you're going to trust with millions of dollars. For any serious investor, this is an absolutely crucial skill, and we're about to walk through the pro-level playbook for getting it right. There's a fantastic quote from Warren Buffett that just perfectly frames this entire discussion. Before you even think about returns or strategies, what our source material really hammers home is this: a manager's character is everything. Because without integrity, that intelligence and energy, they don't just become useless, they become dangerous. They will kill you. Keep that in mind.
Okay, so here's our game plan for today. We're going to start with a pretty serious warning. Then, we'll get into the search for a true guru. After that, we'll tackle the two big hurdles of due diligence, that's investment and operational. And finally, we'll see why even after you've cut the check, your job is really never, ever done. All right, first things first, a major reality check. Before you even start daydreaming about finding the next great manager, you've got to understand the immense risks and the really demanding requirements that define this world.
Our source does not pull any punches here. It basically says hedge fund investing should come with the Surgeon General's warning. The message is crystal clear. This is so not a game for the unprepared. It demands rigorous, honestly exhaustive homework.
And that brings us to this number, $1 million. This really shows you the high barrier to entry. We are not talking about your average E-Trade account here. The source is pretty blunt. If you don't have a cool million or two ready to allocate, this probably isn't the playground for you. It's a world that's typically reserved for what they call accredited investors, folks with a high net worth or income to get into these kinds of deals. So if you've cleared that first reality check, then we can move on. The whole point of successful hedge fund investing, the absolute core of it, is finding a truly skillful manager, a real guru, among the thousands and thousands of people out there. And let me be clear, this is the whole ballgame. For every famous genius you hear about, there are dozens, maybe hundreds of failures you don't. Your entire success is going to hinge on your ability to spot the difference and pick the right person. You're not just finding a good fund, you're finding a great manager. So what does skilled even mean here? Well, the source has a great way of putting it. They're not gamblers, they're odds makers. They aren't just flipping coins. They have a real analytical edge, they think differently than the crowd, and they have this unique ability to find and exploit cracks in the market that nobody else sees. Okay, now we get to the first real challenge. This is where we give you the tools to really break down a manager's investment strategy. Think of it like running the first half of a seriously tough gauntlet. So this is your toolkit for getting through that first gauntlet. Now, we're not going to go through every single item, but let's hit a few of the really big ones. Each one of these is a critical piece of the puzzle you have to solve before you hand over your money. First up, pedigree. And what's super interesting here is that this is not about some fancy resume from a big famous investment bank. In fact, the source warns to avoid these guys like the plague. Pedigree is about a proven history of managing real money through good times and bad. How did they act when things went wrong? That tells you way more than any fancy title ever will. Next, you have to understand the opportunity set. Our source uses this awesome lazy man versus wise man analogy. See, the lazy investor, they just see a great track record and think, awesome, this is going to go on forever. But the wise investor asks a totally different question. Where's the next big opportunity? Is there some real market inefficiency this manager can exploit over the next year or so? It's all about what's coming next. All right, let's talk alpha proposition. And this hits you right in the wallet. Hedge funds are famous for their high fees, right? The classic 2 and 20. Well, alpha is the extra value the manager brings to the table above and beyond what the market is just doing on its own. So you have to ask yourself, am I actually getting my money's worth for those sky-high fees? And one last thing from this investment list, something called convergence risk. It's that terrifying moment like we saw in 2008 when all these different strategies that are supposed to be totally unrelated all start tanking at the exact same time. You need to know if your manager has a real plan for when things get really, really ugly. Okay, so you've made it through the investment gauntlet. Awesome. But guess what? You're only halfway there. Now comes the part that protects you from the really scary stuff, from fraud and total operational meltdowns. And the way our source frames this part is perfect. It's basically the investor's Hippocratic oath. First, do no harm. The goal here is simple. You have to make sure the manager can't do anything completely stupid on the business side of things that could blow up your investment, no matter how good their stock picks are. This is your checklist for that operational gauntlet, and you cannot, I repeat, cannot skip this part. Why? Because when you think about the biggest blowups you've ever heard of,
Think Bernie Madoff. It wasn't a bad stock pick that brought him down, right? It was massive operational failure and, well, outright fraud.
So a huge one on this list is valuation. How are the fund's assets actually priced? You have to insist on an independent third party confirming those numbers. Because if you don't, managers can get caught up in what the source calls marking to their own fantasy. And trust me, that fantasy always turns into a nightmare for investors.
And that brings us to cash flow controls. The source asks a question here that's, well, it's a little blunt, but it gets the point across perfectly. Are there enough locked doors and separate gatekeepers between the manager making decisions, the broker making trades, and the custodian holding the actual money? You need to be sure a rogue manager can't just wire your money to an island and vanish.
So you did it. You survived both gauntlets. You picked your manager, you've written the check, you're done, right? Kick your feet up? No, not even close. Your quest isn't over. Now begins the vigil. The continuous monitoring is absolutely essential. This is your monitoring list, and you've got to be absolutely ruthless about it. Is the opportunity they sold you on still there? Have any key people quit? And their performance. Is it good? Is it bad? And more importantly, does it actually line up with the story they told you? You have to stay on top of all of it. And here's a really big one to watch out for: assets under management, or AUM. This is such a classic trap. A strategy that worked wonders with $100 million might be completely impossible to execute with $10 billion. At a certain point, the fund gets so big that it basically is the market it's trying to beat. And how can you beat yourself? And that all leads to this final, pretty blunt takeaway on monitoring. You have to be ready to act. If you do all this work and find that the manager has strayed from their strategy or the whole investment thesis is just broken, then you have to be ready to pull your money. So there you have it. We've laid out the whole map, from the initial warnings, through the search for a guru, through those brutal due diligence gauntlets, and finally into the long vigil of monitoring. Our source material gives you the path, but it also leaves you with one last big question. After all that, is the treasure really worth this quest? And that's something every single investor has to answer for themselves. So let's talk about something called a fund of hedge funds. Now, I know it sounds a little complicated, but the whole story really kicks off with a simple, high-stakes bet from one of the most famous investors on the planet. And trust me, the ending to this story is probably not what you're expecting. Let's dive in. All right, so full disclosure, Warren Buffett didn't say these exact words, but he might as well have, right? This quote perfectly sums up how he feels about high-fee investment products. He's always believed that a simple, low-cost index fund will beat the fancy stuff in the long run. And to prove it, well, he put his money where his mouth is. So here's the setup for the big showdown. Back in 2008, the Oracle of Omaha, Warren Buffett himself, made a huge wager against a firm called Protégé Partners, a company that manages, you guessed it, a fund of hedge funds. The bet was simple. Over 10 years, which would do better, a basic, no-frills S&P 500 index fund or a hand-picked portfolio of 5 different funds of funds, even after all their fees were paid out. And the winner, by an absolute landslide, was Warren Buffett. I mean, it wasn't even close. Buffett's boring old index fund gave him an average annual return of 7.1%. And those super sophisticated funds of funds, a measly 2.2%. The headlines basically wrote themselves. Simple and cheap, crushes complex and expensive. Game over. But hold on. If that was the whole story, this would be a really short explainer. Buffett's win looks like a total knockout, but it only measures one thing: a 10-year return that happened to take place during a massive bull market. What if I told you that only looking at that number is like judging a car by its top speed without ever checking its brakes or safety features? So, case closed, right? Funds of funds are just a bad deal, a way to pay extra fees for terrible performance? Well, not so fast. If you look at the data a little differently, a much more interesting picture starts to emerge. Let's look at a different time frame and a different set of numbers. Okay, check this out. What's really fascinating here is that top row, the year 2018. The market took a dive and the S&P 500 lost over 4%. But look at the fund of funds column. Yeah, it also lost money, but it lost less money. That's our first clue. But the real secret, the key to this whole thing, is hiding down there at the very bottom: standard deviation. And this is where it all clicks. That standard deviation number,
That's just a fancy way of measuring volatility, or, risk. And look at that difference. The S&P 500 is more than twice as volatile. You see, the main goal of a fund of funds isn't always to hit home runs during a bull market. Its real job is to protect your money and give you a much, much smoother ride. It's built to lose less when everything goes wrong. So now that we get that their main job is managing risk, let's back up. What exactly is a fund of funds anyway? Well, think of it as building the ultimate investment dream team.
At its core, the definition is pretty simple. A fund of funds, or FOF for short, doesn't go out and buy stocks and bonds directly. Instead, it's a portfolio that invests in a whole bunch of other hedge funds, all carefully selected and managed by a professional.
Remember the 1992 Olympic basketball dream team? With Michael Jordan, Magic Johnson, the whole crew. A fund of funds manager basically does the same thing, but for the world of investing. They scout the field and handpick a team of all-star hedge fund managers. We're talking legends like Stephen Cohen, Daniel Loeb, and Izzy Englander, and then they blend all their different strategies together into one single portfolio. So, what do you get for being part of this dream team? And maybe more importantly, what's the catch? Well, it really all boils down to 3 huge advantages and one very, very significant drawback. The 3 big selling points are pretty compelling. You get access to elite managers you could never invest with on your own, you get diversification across a ton of different strategies, and you get a team of pros watching over it all for you 24/7. Let's kick off with access. So you got a spare $10 million just lying around? Yeah, for most of us, that's a hard no. And that's often the minimum price of admission to get into one of the world's top-tier hedge funds. A fund of funds pools everybody's money together, giving certain qualified investors a seat at a table they could never, ever get to by themselves. Next up, diversification. By investing in a portfolio of, say, 30 to 50 different managers, a fund of funds protects you from a total disaster. If one of those managers makes a really bad call and their fund just implodes, it's not going to sink your entire ship. It spreads the risk way out, which, as we saw, is a huge part of that low volatility strategy. And finally, professional monitoring. Let's be real for a second. Picking and managing hedge funds is incredibly complicated stuff. It takes a ton of research, due diligence, and constant oversight. With a fund of funds, you're basically outsourcing that massive job to a team of experts whose only mission is to find the best managers and make sure they're doing what they're supposed to do. Okay, so what is the catch? It's the one thing Warren Buffett was betting on from the very beginning: fees. You see, you're not just paying the fees that the individual hedge funds charge, you're also paying an additional management fee to the fund of funds manager, right on top of it. It's 2 layers of fees, and that can really eat into your performance. So why on earth would anyone agree to pay those extra fees? Well, the argument is pretty straightforward. You're paying for a service. That extra fee is what buys you the access, the diversification, and the professional oversight. 3 things that are super valuable and really hard to get on your own. You're essentially hiring your own personal chief investment officer. So, after all that, what's the final verdict? Who was right in that big bet? Buffett or the hedge funds? Well, the funny thing is, they both were. It really just depends on what kind of game you're trying to play. And that's the key takeaway here. These are different tools for completely different jobs. An S&P 500 index fund is built to capture the market's upside and maximize your returns, which is awesome when stocks are soaring. A fund of hedge funds is built to minimize risk and protect your capital, which is most valuable when the market is tanking. One is built for offense, the other is built for defense. And that really brings us to the final question, the one you should probably ask yourself. When you look at your own investments, what are they actually built for? Are you only set up for smooth sailing and sunny days, or have you built a strategy that's also ready for the inevitable storm? The answer to that question tells you a whole lot about which tool might be right for you.
So you're thinking about a career in finance. You've probably heard the stories, the legends, and maybe you've dreamed about landing the ultimate gig working at a hedge fund. It's seen as the absolute pinnacle, the major leagues. But what does it really take to get in? And maybe, more importantly, what does it take to survive once you're there? Let's get into it.
And that right there, that's the hook. This quote from Fortune magazine just perfectly sums up the incredible pull of the hedge fund world. It's not just a job, is it? It's a promise of a life that's on a completely different track. It's the ultimate financial dream.
Back in the late 90s, this dream sparked a kind of mass migration.
You had the smartest, most ambitious people on Wall Street leaving these super prestigious investment banking jobs, all to chase what you could call the hedge fund fever. So what was causing this massive gold rush?
Well, it really boils down to 4 huge draws. First, the earnings potential is just legendary. I mean, it blows traditional banking out of the water. Second, you get this incredible entrepreneurial freedom. You live and die by your own calls. There's no slow-moving corporate bureaucracy, no dead weight holding you back. And believe it or not, the cost to get started was surprisingly low. For the sharpest minds on the street, it just felt like the perfect game.
And when we say uncapped earnings, we are not kidding. The numbers here are just staggering. In 1 year, 2006, the top 3 hedge fund managers each took home more than $1 billion. $1 billion. To put that in perspective, the CEO of Goldman Sachs made headlines that same year for a record-breaking $54 million. I mean, it's just a completely different universe of wealth.
But, and this is a huge but, all that money, all that glory comes at a very steep price. This is not a 9-to-5 job. The real price of admission is surviving a culture so intense it literally breaks most people who try. So let's flip the coin and look at the other side.
The culture is famously, almost brutally unforgiving. We're talking zero tolerance for mistakes and even less for what they might call, well, weakness. And high turnover? That's not seen as a bug in the system, it's a feature. It's designed to constantly weed people out so that only the absolute strongest are left standing.
Ken Griffin, the legendary founder of Citadel, put it perfectly with this analogy. The firm, that's the bus. It has a destination, and it will get there. You can get on, you can get off, or yeah, you can get thrown off. But the bus itself is relentless. It just keeps moving forward. You are not the mission. You are just a passenger.
And if you need an example of just how brutal this world can be, well, look no further. This is a real story about Michael Steinhardt, one of Wall Street's most successful managers ever. An employee makes a huge, costly mistake and is in total despair. And that was his boss's response. It is absolutely shocking, but it shows you the raw, unfiltered reality of this pressure cooker environment.
So, knowing all of that, the real question becomes, are you built for this? It's not just about being smart or good with numbers. It's about having a very, very specific psychological makeup. Let's take a look inside the mind of your typical hedge fund professional.
A survey of people in the industry gives us some really fascinating insights. No big surprise, almost everyone, 90%, is in it for the money. And it's still an overwhelmingly male-dominated field. But look at this last one. More than half of managers constantly think about failure. This isn't just about being confident. The culture is defined by this relentless paranoia, this deep-seated fear of losing.
Okay, this brings us to a little moment of truth. I'm going to run through a quick quiz based on what these managers are actually looking for. So be honest with yourself. Could you really make it here?
First up, the pressure test. Can you genuinely flourish when the heat is on and everything's on the line? Are you okay with being wrong a lot? And can you admit it instantly to cut a bad trade and move on? And when the market is tanking and everyone else is panicking, can you stay completely rational? All right, next is the team test, because it's not all about being a lone genius. Can you actually be part of a team, sharing the wins and the losses? Can you fight the ego trap of hoarding your best ideas or stealing credit? And are you committed to always learning and to eventually becoming a positive force and a mentor within the firm? If you can honestly say yes to all of this, you might just have the right temperament.
Okay, so you've done the self-assessment and you still think you have what it takes. Fantastic. Now let's get down to brass tacks. How do you actually get your foot in the door of this incredibly exclusive club?
There are really 3 ways in. You've got blind outreach, basically just blasting your resume out there. It has the lowest chance of success, but hey, you got to start somewhere. A step up from that is the warm call, where a friend of a friend gets you a direct contact. But the most effective path, the holy grail, is the referral. That's when a manager needs to hire someone, asks his network, and your name is the one that comes up. Once you land that interview, you have to absolutely nail it. And the candidates who succeed project 3 key things. First, an attitude of genuine gratitude, like I feel lucky to even be in this room. Second, a philosophy of ownership, thinking like you're a partner, not just an employee. And third, a clear message, I want to build my career here and add real value. And finally, remember that getting the job is just the starting line. To really succeed, you've got to be relentless.
Set clear goals, become an information sponge, read everything, build your network with people who are going places, find a mentor, and most importantly, be humble. In an industry that's defined by ego, hubris is the fastest way to fail. It's like a cancer.
So there you have it. The dream, the nightmare, and the playbook. The path to getting rich, so fast, so young, it's all laid out. But the ultimate question, the one you have to ask yourself, is this: what's really driving you? Is it a genuine passion for the markets, or is it just the paycheck? Because the answer to that question will determine everything.
So today, we're jumping into the pretty misunderstood and, let's be honest, often criticized world of hedge funds. It's an industry that you could say is constantly climbing a wall of resentment and scorn. But what if all that negativity is actually missing the point? We're going to explore a really interesting paradox, why the very trouble and complexity that makes everyone so nervous might actually be the biggest opportunity of all.
The obvious isn't obvious until it's obvious. This quote from Anthony Scaramucci just nails the world of investing, doesn't it? The best opportunities, the biggest truths, they're usually hiding right there in plain sight. And today, we're going to try and uncover a few of them.
Okay, so first things first, let's just get it out there and address the elephant in the room. High finance, and especially hedge funds, they don't exactly have the best reputation, right? We have to start right here by looking at this wall of scorn.
And these probably all sound pretty familiar. People point the finger at the industry for, well, pretty much everything. From the 2008 financial crisis to the growing wealth gap, you hear that all these complex tools like derivatives are just toys for the rich, that private equity is just about tearing good companies apart for profit, and that hedge funds, they're just a way for managers to get rich. I mean, even the great Warren Buffett seems to disagree with their whole model, telling everyone to just buy and hold. It's a really powerful and, a very persistent story.
But here's where it gets interesting. Here's the twist. The author, who is a total hedge fund insider, he starts his entire argument by saying, you know what, sometimes the critics are 100% right. Sometimes the absolute best strategy is the simplest one.
And to prove his point, he tells this great personal story. Back in the late 80s when he was at Goldman Sachs, he bought a little bit of Microsoft stock for his kids. Just a simple, straightforward investment. And here is the absolute key to the whole thing. He didn't try to time the market. He wasn't trading it. In fact, he completely, totally forgot he even owned this stuff for a whole decade.
So, what was the result? Well, by the time he remembered he had the account, its value had just exploded. It was through the roof. His absolute best move was making no move at all. Doing nothing turned out to be a spectacular win.
And this leads to a kind of a dark but very memorable saying on Wall Street. The best performing accounts, they often belong to clients who are dead. Why? Well, it's pretty simple. They can't get scared and panic sell at the absolute worst moment. They're totally immune to all the emotions that trip up the rest of us. So yeah, clearly, the simple set it and forget it strategy, it's got real merit. But is that the whole story?
Because here's the big but. That simple forget your money strategy, it works perfectly, right up until the moment it doesn't.
The whole argument for needing a more complex approach really hangs on this one simple truth. The world is messy, and markets do not go up in a straight line. Crises are not a possibility, they are an inevitability. And when real trouble hits, you can't just bury your head in the sand and hope for the best. Suddenly, doing nothing isn't an option anymore. And that's exactly where active strategies, hedging against disaster, finding opportunity in the chaos, become absolutely essential.
And I mean, we really don't have to look far for proof, do we? Just think about the last 2 decades. We've had a global financial crisis that almost broke the world, a global pandemic that literally shut down the planet, not to mention major wars and massive political instability. Every single one of those events sent huge shockwaves through the market, proving that trouble isn't some hypothetical idea. It's a constant. So, if the world is really this chaotic, how do you win? Well, this brings us to a really powerful concept. The idea of Mr. Market as the ultimate impartial judge.
I want you to think of Mr. Market as this force, this personification of the financial world. And here's the thing about Mr. Market. He doesn't care where you went to school, who your parents are, or what you believe politically. A person with a PhD from a fancy university can blow up a fund just as spectacularly as anybody else.
Yeah, all that stuff that society uses to judge people, your family name, your background, all those degrees on your wall, it is completely and totally irrelevant here. Mr. Market cares about two things and two things only: how you think and how you act. That's it. It's a true meritocracy, which is both brutal and kind of beautiful in how fair it is.
So, how do you play to win in a game that's judged by this tough, impartial force, especially when you know trouble is always just around the corner? Well, our source lays out 10 crucial rules for playing the game.
The first 5 rules, they're really about building your foundation. It all starts with passion, but not just for money, a passion for the craft, for the puzzle of managing money. From there, you build a network because your best ideas will come from other people. You read constantly to stay ahead. But all that knowledge is pretty useless if you're not also deeply curious and just a little bit skeptical to protect yourself from bad ideas, including your own.
The last 5 rules, they're really about character. You have to manage the incredible stress of this world, so exercise and taking time off are non-negotiable. You need the humility to know you're not the smartest person in the room and to admit when you mess up, fast. And then there's the last one, the secret sauce of all the legends. Go out of your way to help other people. Success isn't just about what you can take, it's about what you can build with others.
So after going through all the criticism, the complexity, the constant threat of disaster, the author's final piece of advice is really just a powerful call to action. He says, look, don't be afraid. Don't let all the noise scare you away from the game. Don't opt out, because if you do, you're going to miss out on some amazing long-term growth.
And that's the paradox, right? The simple way can work, for sure, but a truly complex world demands a more resilient strategy, one that's governed by the tough but fair rules of Mr. Market. The final message here is to lean into that complexity, not run away from it. And that really leaves us with a question for you. Faced with both the risk and the opportunity, will you answer that call? Thanks for tuning in.